Hi, and welcome back to the channel. And what I'd like to speak to you today is the difference between unit trusts or ETFs. Now, unit trusts are also called, in some countries, they're called mutual funds. And obviously ETFs is only called ETFs. But so let's start. So what are they? So, for example, first of all, you have a share, in other words, a stock that's on the stock market. So each stock is a part of the company that's listed, and then they've got shares in issue. Okay, so now what happens is with a unit trust. Imagine, to make it easier to explain. This is obviously for beginners, just to explain to them how things work. If you have a supermarket basket or a trolley, if you have a supermarket trolley or basket, you go to the supermarket and you see, there's something on the shelf, I'll grab that. There's something on the shelf, I'll grab that, and you put all of that in the trolley. Now, what you can compare that to is that your items on the shelves are like companies or portions of the companies that's listed on the stock exchanges, and your basket is the holding of the ETF or the unit trust. Now, the unit trust and ETF basically work similar in that they all are pulled together so it's like a basket of shares that you actually, when you buy, if you buy a unit trust, you buy units in that unit trust, and each unit you buy is a portion of that basket or trolley of companies. So in other words, you're buying a very tiny portion with each share that you buy, with each unit. So the difference, they're both made up of a trolley like that with different companies in. The difference between the two, the unit trust, they only get priced at the end of the day. So no matter what happens during that day, I mean, the stock market can start up, it can go down again, it can go up again, it can go down again, or vice versa. It can be all over the place. What happens with the unit trust is they take the price at the end of the day. Whether you want to buy or sell, they take the price at the end of the day. So that's how they work on that. With the ETF, it's what we would say is live. So in other words, the ETF, that basket, is trading like a share trades on the stock market. It trades live. So in other words, if you can buy or sell an ETF at any time, you can buy one ETF at 9 o'clock in the morning or whatever, and you can sell another one at 12 o'clock in the afternoon, 1 o'clock in the afternoon, and you'll get the price at that time. Also, when you sell your ETF, the money comes straight to you. When you sell a unit trust, it takes about 3 days for them to pay it out, because obviously it's the management companies that's holding the unit trust have to sell units, and they have to then obviously make cash available and then pay you out. So that's the difference between the two. Also, what you can do with both, you can actually reinvest your dividends. So you can actually set up with the company who do the unit trust or mutual fund. You can tell them, listen, I want to reinvest and obviously if you reinvest your dividends, then usually your growth will be a lot more than if you didn't. With an ETF, you can do the same. You can actually you can do the same with the ETF. You can get your dividends reinvested if you want, or you can do it yourself manually. When they pay out dividends, you can invest manually if you want to, or whichever, that's how you do it. The difference in fees, the fees are usually a little bit more on a unit trust. Okay, and then they make fees by what they call a spread. In other words, you get a buying price and a selling price. Your buying price is higher than your selling price. ETF is the same. Your buying price is higher than your selling price. So in other words, when you buy units, you buy at the higher price, and then when you sell at the lower price. That difference is called a spread. And then obviously the company that's holding the ETF or the unit trust make money on that, and then like they charge usually then an annual fee. Now with the ETF, you'll find your annual fee is lower on an index fund or a passively managed fund. In other words, a passively managed fund is they buy the index or they buy certain stocks, and they don't trade a lot. They just buy the index. They may be obviously the index changes over time. So maybe once every 6 months or whatever, they will then buy and sell to mirror the index that they're investing in. But the passive is very little trade. So the costs are a lot lower. You know, your unit trusts like that, I mean your ETFs like that, like it's 0.02, 0.03%, maybe 0.04. Whereas your actively managed funds. In other words, they are trying to actively manage and position in the market and buy and sell to try and get a higher return for you. If they do that, then an actively managed fund will be higher charges. Okay, so that's something you've got to look at when you go into that. Okay, so yeah, like I say, you can sell anytime. Both of them is good for diversifying. So in other words, because you hold a basket of shares in your unit trust or your ETF, you diversifying. In other words, you're not holding one share. If you're holding one share, that share can be doing very well. The company can be doing well, but the share can sometimes go against that. So sometimes the price can go up and down. Usually over time, it's usually will go up, but if you're only in one share, then you're more at risk with that one. If the investment goes bad, then obviously you lose a lot, or you lose all your money with that. If you invested over a basket of shares, then obviously your risk is less, because one could do excellent and one could do bad, and then sort of it balances out, and then so that's why they do it like that. Okay, so which is better? Which is better, unit trust or ETF? Well, that depends on you. That depends what you're looking for with your investments. There is good and bad things to both. So yeah, I hold both. I hold the ETFs. I've got some ETFs, and I've got some ETFs in a tax-free savings account. So I'm holding ETFs. I like the way the ETFs are more flexible, but the thing is, your unit trusts, over time usually they grow, and especially if you set up a debit order, and also that's the other thing I wanted to talk about, the amounts. So in other words, you can pay 50 Rand into your ETF, you can pay 100 Rand, you can pay 1,000 Rand, you can pay in 1 month, you can then not pay the next month. So you can pay in whatever amounts you want to at any time. With a unit trust, it's a little bit more unflexible, where you have to pay. There's usually a minimum lump sum. Different companies have different minimums. So you've got a minimum lump sum that you would have to pay. In other words, some of them it's 1,000, some of them it's 10,000, some of them it's 100,000. So you'd have to pay that minimum to actually be able to invest. Some can actually dollar cost average or rand cost average that amount in. In other words, if you pay them the lump sum, you can say they can pay that in over 12 months or 24 months or something. I know some can do that, some don't, but some can do that. But usually you would pay like a minimum debit order. So in other words, your debit order would be 500 Rand a month or 1,000 Rand a month or something like that. So usually then you pay your you set up your debit order, and then even if you can, you increase it by 5 or 10% or whatever, and that amount will be paid in, and then you can just leave that to grow. And then if you check it in 10 years' time, you should be making some nice money. ETFs, you can also make good money on there. Like I said, the charges are usually slightly a bit less on the ETF, and they are more flexible. So you can buy and sell anytime you want to, but obviously for me it's not a short-term investment. It is a longer-term investment, 5 to 10 years minimum. 5 to 10 years. I would look at a unit trust and an ETF, 5 to 10 years minimum, maybe even longer than that. Obviously, the longer it runs, the more the compound interest. It'll grow compoundly over time. So the longer you can leave it, the better. So it's not a thing of, oh, I'll buy a unit trust now and sell it in 6 months, unless you really need the money. Then you say, oh, I haven't got anything else. But your unit trust and your ETFs, the best way to play them is to buy and then hold them over the longer term, and then you will see your wealth increasing if you do that on both of them. Okay, and if you've got any questions, please let me know. If you'd like to ask me to speak on any subjects, I'm willing to do that. I'll have a look into what you want me to speak about. I'll speak about individual stocks if you'd like, or I'll speak about the market as general. I've got a few ideas what I want to do over the next little while. But yeah, have a wonderful day, and let's hope your investments grow over time. And yeah, just don't be freaked out by the market's little ups and downs and stuff. Over time, the market will do well. You do get short sellers and traders and stuff, and they make money, and that's great. But for me, I'm more of a longer term investor, buying and holding, and increasing. If you have a drop in the price, then you can actually add more at the lower price, and then that's like similar to rank cost averaging. So let's and I think now going into this, well, we're in December. I think going towards the end of the year, we might have a bit of a rally. Let's see what happens. Our rand was a little bit stronger today against the dollar, so let's see if that continues. But yeah, have a wonderful day.